But there are people who are talking about it. This is Anshu Jain. Anthony Jenkins at Barclays, for instance, has linked compensation. I mean, I think this is a great quote, but for me, I'll read it to you just in case it's too small. Everything has changed. If you take a look at the way we promote people, the way we compensate people, the deals we do, the clients we adopt, there is a meaningful and significant difference between our business model 5, 6, 7 years ago and today. Now that's great, but there's a piece there that for me is missing. The bit is that he doesn't talk about hiring practices. And I've talked to Goldman Sachs about this. I haven't actually talked to Deutsche Bank, but I've talked to Goldman Sachs here in Asia, the head of Goldman Sachs here in Asia, about this. And I don't think it's true to say that hiring practices have changed. And my favorite thought on this is, if you hire hooligans, you're going to get broken windows. And it doesn't matter how much you try and change the culture of the organization. If we don't start hiring people who have the right behavioral characteristics, how are we ever going to change the businesses that we operate in? And the simple thinking there is, by the time you're hiring an investment banker at 23, 24, their character is pretty much set in stone. And we should be doing a better job of making sure that we positively screen for the attributes that we want. Now, all of this, obviously, it's difficult for public companies. Public companies are driven by quarter-over-quarter profit numbers, and I think that's the other aspect. It's all very well for us to talk about these behaviors and to expect these improved behaviors from the investment industry and from the financial services industry. But if investors don't expect that as well, then I think very little will change. We're doing our own bit at the CFA. We've launched a new program called Claritas, and Claritas is aimed at the 90% of people within the financial services industry who don't actually work in front-facing jobs. The idea there is that they too need to be trained in the vocabulary of the financial services industry. They need to be able to communicate with their peers and their colleagues. But they also need to be trained in business ethics and in their responsibilities towards their companies. And I think it's that last thing that I'd also point out in the CFA world. One of the most depressing things for me in my job in the CFA is that we haven't yet made this transition from exam provider to profession. And it's not just the CFA, but I think the CFA numbers are quite interesting in that regard. We have an 80% retention rate only in the CFA in Asia, i.e. 20% of everybody who struggle through 3 years of exams, 4 years of getting sufficient professional responsibilities under their belt to get the CFA, then lapse their CFA. They have no interest in remaining a member of a professional body, which is twice the lapse rate, if I can turn it round, over twice the lapse rate, in fact, that we suffer in Europe and North America. And if you think that in Europe and North America, a large part of that 8 to 9% lapse rate is actually going to be retirees, you can see that the problem here, where our membership base is much younger in Asia, is much more acute. We're failing to sell the idea that being a professional is actually important and relevant. And I mean, there's several possible explanations for that, including the fact that we're not doing our job very well at the CFA Institute, and I would certainly accept that as part of the reasoning. But there's also a different cultural issue in China, in the mainland of China, where this is a particular problem, and in India, where it's also a particular problem. That the resonance of being an investment professional just doesn't work as well as it does in the West. Why do people get the CFA? Because they want a job. Why do they want a job in financial services? Because they want to get onto the gravy train. Really. And I think that's essentially the sort of connectivity that we see there. And all of that really, I think, is wrapped around in this thing that if we are to build a profession and if we are to restore trust, it's really a three-legged stool. You've got to have well-educated investors as well as good regulation, as well as ethical investment professionals. Without well-educated investors, and Claritas has its role in that, Investor First Day has its role to play in that, without well-educated investors, the whole system fails to work. Because if the regulator still has to protect investors that are poorly informed, then really they have no alternative but to regulate the investment profession into the status of a utility, really. So again, I'm not sure as an industry, including the regulators, we spend anywhere near enough time on financial literacy. We certainly don't here in Hong Kong, and there are very few countries in Asia that I come across that do. Educating not just institutional investors, and by and large they're woefully badly educated. Anyone who's had to make an investment management pitch to a board of trustees in Asia will know that that is a thankless task, a total mismatch of communication. And not only do we have to work at that institutional level, but we also have to work at the underlying level as well of the investors. So my second theme, increasing regulation. This is a very busy chart, don't really worry about it. It's just meant to give you a quick graphic on the variety of regulations that are coming in the next couple of years. In fact, if you were to extend that to 2020, it would be even more appalling. Most of the regulation going out from 2015 to 2020 is banking regulation. And indeed, that's one of the big sort of micro themes, if you like, that until the banking system has sorted out its business model, and it cannot possibly do that until it's worked its way through a lot of the regulation that's sweeping over the world. It's very, very hard for the asset management industry, which is a derivative, really. It relies upon money filtering down through the banking system to be able to sell its products. It's very, very hard to see how the investment management industry is going to get much of a headway. And the regulations basically can be divided into global regulation that's attacking us, and obviously our homegrown regulation. And the third theme I want to just touch on in regulators is also the fact that Asia is beginning to push back a little bit on this. Yesterday I was in a board meeting for a fund group here. They've had their funds in front of the SFC now in Hong Kong, awaiting re-registration for 10 months, trying to get the SFC to look at their fund documents and pinging those back and forth between them. 10 months. Why? It's because the fund family that they have for sale here in Hong Kong is a UCITS fund family. It's a European fund family, and UCITS grew up, as you all know, really after the financial crisis in 1998 as a mechanism for fund sales. Now recently, Asia is beginning to push back on that. Asian regulators are no longer interested in passporting foreign fund families into our domestic markets here. So that's why we've got things like the China-Hong Kong Mutual Fund Recognition Treaty that, touch wood, is going to happen shortly. That's why we've got things like the ASEAN passport that hopefully will come to pass shortly, and the APEC fund passport that's coming to pass. The regulators here in Asia feel that European regulation has gone way beyond what we actually need here in Asia. Most of our markets, most of our investors are much more simple in terms of their investment requirements than in Europe, where obviously UCITS 4, which we're now on to. Unfortunately, I'm old enough to remember when UCITS 1 was launched, but UCITS 4 now has a lot of derivatives within it. Hedge funds are permissible under UCITS 4. And so the regulation has gone way beyond what the average Asian investor wants. And so the regulatory response to that is to try to promote now some of these domestic schemes. And for anyone in the audience who has any influence at all with the IRD here in Hong Kong, please, please, please get them to address the biggest issue here that we need to get our own fund platform going in Hong Kong, which is open-ended investment company legislation, which we're discussing with the regulators at the moment. But until the taxman comes on board with that, it's still going to be a struggle. So I wouldn't say that that these platforms are going to get much traction in the near term, but I do think they're beginning. And when we look at the Hong Kong-China mutual recognition platform, I do think that's interesting in terms of a straw in the wind of what that means for us all in Asia, i.e. the rise of Chinese asset management industries, Chinese asset management industry. What's in it for China to recognize Hong Kong funds? Well, it's the usual, I think, mainland story. What's happening there is that Chinese authorities are conducting, through Hong Kong recognition, a limited scope experiment to see how competitive their own asset management companies are. And I think that's really what the importance of this scheme is about, is Chinese asset management companies beginning to test their international capabilities against foreign fund management companies. And I think, if I was to make one prediction in the next 10 years, it would be at some point in the next 10 years, a Chinese asset management company is going to buy one of the major names in global asset management today. They certainly have the money to do it. They as yet don't have the self-confidence to do it. They don't feel that they have the right personnel, perhaps, at the top of those organizations to be able to run a global business. And so things like Hong Kong-China mutual recognition, when you look at them on first blush, you would think, well, that's all one way, really. We can see the advantage for Hong Kong in that. We can't see the advantage for China. I think the missing piece there is that this is part of the education of Chinese asset management businesses, trying to get them ready for global competitiveness. Fiduciary capitalism is my third theme. Until about 6 years ago, you would never have heard about sovereign wealth funds. Now you can't move without them. Quick statistics in terms of the way that retail fund investment has declined and institutional investment has increased. The point about fiduciary capitalism is that sovereign wealth funds, foundations, large insurance companies basically own the market. And if you own the market, it implies two things. You own all the good things in the markets and all the bad things in the market. And also, you actually can't disinvest. So you're stuck, really. You're running the most ginormous index fund. And so fiduciary capitalism has a couple of, I think, very significant interests. Firstly, if I was a young person today, I wouldn't be going to work for an asset management business. I'd be going to work for a sovereign wealth fund. I think the better jobs, the more interesting jobs are going to be amongst the asset owners rather than the asset managers. And I think that's a sea change in the way that our industry will work over the next couple of decades, that asset owners will become much, much more important to the way that the fund management system works. It's going to be less about financial intermediation and more about asset ownership. And fiduciary capitalism implies, as I say, that because you own the market, if you want to influence the market, you have to be active within the market. You can no longer take a passive stance towards your investments. You have to have a certain amount of shareholder activism in terms of the way that you approach your portfolio holdings. So I think you'll see that as a trend as well going forward. And we do see it in Asia, although obviously in Asia it's complicated because a lot of our companies are still very closely held, still dominated by private investors rather than by institutional investors. So the percentages in some companies are a lot lower in terms of minority interests. But little by little, you will see these things change. You'll see companies have a higher percentage floats. You'll see that their floats are dominated increasingly by institutional asset owners, and that gradually the corporate governance, the ESG responsibilities within those companies will improve.